Welcome back, everyone. I hope you're having a good day today. Today, I wanted to go over my investment strategy, mainly into why I think that investing into individual stocks is going to be beneficial for me in the long run and why I think some people should do it as well. Before we get started, I want to say that those not willing to put in the time or effort into investing in individual stocks, please just put your money into an ETF or even something like bonds. Something very easy, very simple. Don't speculate, don't gamble, don't waste your money. To start off, let's go over the starting capital that I plan to continue allocating into both my portfolios with. With great discipline, I plan to maintain earning more than I spend on a regular basis. Combining that with sticking to a budget plan, I will have the capital to consistently allocate cash into my investments slowly but surely over time. The following is my basic allocation of cash between my two investment accounts. I have a Roth IRA and a taxable brokerage account. My plan is to contribute to my Roth IRA, which will be completely allocated to two different ETFs, being SCHG and VOO, allowing it to grow steadily in the background throughout my career tax-free. I opened this account in 2021, and at some point in 2027, I plan on withdrawing $10,000 from this account tax-free for a down payment on my first home, taking advantage of the Roth first-time home buyer exemption. With my taxable account, I plan on investing into 8 to 12 businesses that I believe will provide me with returns that outperform the broader stock market over a long period of time. My current number of holdings is around 10, and I will be releasing another video soon going over my entire stock portfolio. Now let's discuss the qualities of the businesses that I plan to be invested into over the foreseeable future. This will be what I'm looking for in a business before I decide to allocate any capital into the stock. Let's start off by reviewing attractive traits a business can possess. First off, monopolistic market position. These businesses often have little to no competition. They're typically in a duopoly or oligopoly with just a couple of shared competitors. Good examples of businesses in this situation would be Visa and MasterCard or S&P Global and Moody's. Secondly, we love for our companies to have high barriers to entry, meaning to compete with this business, there's tall hurdles for them to climb over. Think of something like a GE Aerospace or even a Boeing. Businesses like that have often decades or multiple decades ahead of any competition entering their space. I want my businesses to have multiple layers of competitive advantages or moats to protect the core business from any competition. Think of something like FICO that has virtually no competition and is a language in the credit world. A business that is very predictable with its future expected free cash flow and earnings is crucial as it's nearly impossible to put a value to something that's super cyclical or unreliable in the future. Think Visa and MasterCard, who are growing quarter over quarter every single year. The next trait being super important. We want our companies to have pricing power, or in other words, the ability to raise prices above the rate of inflation without driving away customers. A great example of this is Microsoft. They've continually increased prices without losing customers for decades now. We also like to look for capital-light business models that don't require large investments into expensive physical goods. A company that comes to mind for this is MSCI and S&P Global's index businesses with insanely high margins and almost no need for reinvestment. We also want the management teams of our businesses to have very intentional and appropriate capital allocation. We don't want them wasting cash on acquisitions, overpaying staff, or even hoarding cash instead of returning it through buybacks or dividends. There's plenty of examples of companies allocating poorly, including most of the legacy cable companies over time. We also want companies to have long avenues of forward-looking organic growth. That meaning that they should see increases in business activity in their already existent lines of business. Lastly, we're looking for businesses that earn high returns on capital, meaning if they were given or earned additional capital that they could get good returns on their investment. We're typically looking for around 20% or greater return on invested capital. Now for some qualities that we want to avoid when looking at a business. We want to avoid companies facing competition. Think of apparel, commodities, etc. We also don't want to invest into businesses that haven't established a proven business model over an extended period of time. We definitely want to avoid companies who have rough balance sheets. An overwhelming amount of debt can weigh on business capabilities and weigh heavily on earnings due to interest payments over time. A good example of this would be AT&T, who tried to buy success but has been drowning in debt for years now. We don't want to be involved with reckless management teams that will constantly dilute shareholders, overspend on investments, and allocate funds insufficiently. We don't want companies who have to buy growth to be successful. Warner Brothers Discovery has suffered from these practices, and now today they're having to sell the company. We strongly prefer to avoid capital-intense business models as over the long term, this increases risk and hurts the overall ability to produce free cash flow. Think of companies like airlines and car companies who have to invest heavily into big physical goods. We don't want companies to have poor allocation practices, whether that be sitting on cash, allowing it to depreciate on the balance sheet, or overspending for a number of different reasons. We want to fully understand our businesses, therefore we're going to avoid companies that are near impossible to understand or that rely on the highest quality of scientists or engineers in order to operate. Lastly, we're going to avoid dual-class shares where some people have more voting rights than other shareholders, which causes misalignment. As long-term investors, we want to focus on quality over cheap businesses. The highest of quality businesses are far more predictable and successfully growing their earnings and cash flows over extended periods of time. Buying a company that you know will continue to grow and spew profits over the long run will allow the fundamentals of the business to catch up to the valuation and therefore certainly grow share price exponentially over time. Investing into a good or average company at a much lower price opens up the door for competition to eat some of that company's lunch or for the company to simply sabotage itself with bad management and capital allocation. The idea is never to overpay, but if you can buy the best of the best businesses at fair prices, they will far outperform above average businesses at depressed valuations. After placing our bets, the last thing left to do is to do nothing. Arguably, the hardest part of the entire strategy is what you do after allocating your invested capital into the best bets that you can find in the market. The only thing left to do is sit back and let them compound for you. Of course, keep up with the companies you're invested in to ensure they're staying on track with your initial investment thesis, but don't get distracted by other opportunities, and don't feel pressured to make any changes or sell out of positions that are performing well unless you see a severe case of overvaluation. Let's look at an example here. Microsoft, we'll pull up the share price over time. As you can see, 10 years, it's grown 24% annually, which is amazing. Incredible returns, right? Currently around $460-ish dollars. It was $50 10 years ago. Let's look at the valuation. Here's the last 10 years. You could have bought it as high as a 42 PE in 2016, up to a 60 something PE in 2018, a 38 in 2020, high 30s here and there. It drops low, your returns accelerate, but back to the overtime price, it doesn't really matter. What matters is that you're in a high quality company that's growing earnings over time. The valuation will catch up to the earnings. That's all I've got for today. Thank you guys so much for watching. Make sure to subscribe on your way out and have a good day.